Hi friends, welcome to this video on understanding the importance of term insurance. Insurance is basically a contract between two parties. One party can be an individual, the other party will be a life insurance company. By getting into this agreement between these two parties, the individual can transfer his own risk to an insurance company, for which he is obliged to pay a premium. Insurance act as a risk management tool. How? Suppose you are having your own four-wheeler which can create a damage for a third party. Just to have a damage control, you can take a motor insurance which will give you a comprehensive coverage against your third party damage too. Insurance act as a protection for the family and the dependents in absence of the breadwinner. Insurance act as a liability cover. How? Let us see a simple example. Mr. Sam, who want to purchase his dream home, for which he is approaching a bank to take a loan. Suppose the bank has sanctioned him 25 lakhs rupees of loan, by which he have fulfilled his dream of buying a own house. Now bank is carrying the risk of Mr. Sam because any eventuality happens to Sam, the loan will get defaulted. The family will also face a crisis because they want to liquidate this asset in that circumstance to repay the dues to the bank, for which Sam can do a simple planning by taking a term insurance against his loan amount, so that any uncertainty happens, the insurance company will settle the due amount to the bank and the balance amount will be paid off to the nominee. Hence, by this form of arrangement, insurance act as a liability cover. Insurance is also a savings. This is the third generation definition because unit linked insurance plan is providing both insurance benefit as well as the savings benefit to the investors. What insurance actually covers? It covers death by providing term insurance plan. It covers disability by giving you a range of health insurance plan. It also covers disorders, something like critical illness. It covers liability like providing loan insurance and motor insurance, etc. What you actually buy from an insurance company? You buy financial protection for your family, you buy peace of mind for yourself and a tax benefit too. As you are aware, the premium contributed towards insurance policy will be eligible under Income Tax Act 80C. Who should buy insurance and how much life cover to choose? This is the common question arises in the mind of every individual. The ideal way to ask yourself is, when should I buy insurance and how much life cover to choose? Because if you ask yourself who should buy insurance, then of course it is everyone, because every human carries a value and every human carries a element called risk. So everyone need insurance. The ideal way to ask yourself is, when should I buy insurance and how much life cover to choose? Let us take a two simple scenario which can tell you what is the ideal time to buy a term plan. Suppose at your bachelor stage you will not have any dependents, you will have low responsibility being a student, hence you carry a very low amount of risk. The premium will also be very low since your age is lower. When you become a breadwinner, you will have dependents, hence your responsibility will go for a toss, your risk level increases and the premium also increased due to your increase in age. If you ask me when should I buy a term plan, ideally I would say when you are a breadwinner, no. When you are a bachelor, you need to buy a term plan because you get a benefit of starting early. You can start with a discounted premium. How much life cover to choose? These are the list of variables which influence the purchase of life insurance plan. One is gender and the dependents, occupation, income and expense, liability. These variables will decide how much life insurance you need to buy, for which we are going to do a simple case study of Mr. Sam and his family who want to leave rupees 5 lakhs per annum for his family in case any eventuality happens to him. The calculation part carries two sections. One is the assumption, other one is the actual calculation. Let me list out the various assumptions we are going to have for this calculation. One is the inflation rate, which is 6.5%. The importance of taking this assumption is the rupees 5 lakhs which he want to leave for his family member will not be a constant amount for rest of the years. Suppose today's 5 lakhs may not be the worth same tomorrow. There will be an inflation effect. Hence we are taking an assumption of 6.5% is the inflation rate, and we also consider a risk-free rate. What is this risk-free rate? Suppose anything goes wrong today, the sum assured amount received by the family member will be invested into some deposits. Assuming 8% is the rate which is offered by banks, which can give them 5 lakhs as an interest every year. Expense is nothing but the total sum amount required for the family to take care of their basic needs in the absence of Sam. So this 5 lakh will not be a constant amount because of the inflation effect. And we have taken the spouse age as 35, where her life expectancy is 70. Based on this assumption, we are going to compute how much life cover is required for Sam if he choose a term plan today, for which we need to list out some of the important variables for the computation purpose. One is the income. Income is nothing but the expense amount expected from the sum of amount which received by the Sam's family. To put it in another way, it is nothing but the receivable. Receivables is rupees 5 lakh for rest of the period till the life expectancy age of 70. What is the tenure? How many years do you think Sam's family need to receive this 5 lakhs on an annual basis? All you need to do is subtract the total life expectancy of his spouse with her current age. We can able to find the tenure. Now we need to be more careful while calculating the inflation adjusted rate. This is the most important rate we need to calculate, because the receivables of rupees 5 lakh will not be the constant amount. It should get adjusted with the inflation rate. So we are adjusting the inflation rate with the risk-free rate, for which we need to do this formula: 1 plus 8% divided by 1 plus 6.5% minus 1, and click on the percentage and increase the decimals based on your need. The inflation adjusted rate is 1.4%. Now you need to calculate the amount of insurance required for Sam today if anything happens, for which you need to write a PV function. Just input the rate as 1.4%. NPER is the time frame, which is 35 years is the time frame where Sam's family want to receive this amount of rupees 5 lakhs. PMT is nothing but the cash flow. Here it is a inflow amount of rupees 5 lakh. Always mention prefix minus. There is no future value. And type should be 1, because the income expected out of this corpus should be received at the beginning of the period. Hence it is 1. Now you can figure out the total insurance required for Sam as on today. Similarly, you can do a different workout by changing the input of these variables accordingly. That's all about the insurance planning. To learn more about financial concepts, you can just log on to www.finschool.in. Thank you.